The dividend rate band. Again, this gets me going. Nick Burnett said to me, "Are you going to rant?" I said, "I'll try not to. Nick, I will definitely try not to." And I sense I failed. I failed in my attempts. They only introduced the damn thing less than a year ago. In less than a year, they've decided that an allowance that was introduced with the aim of fiscal neutrality, because they were jacking up the rate of tax on dividends generally, but as a sop, the first little bit wouldn't suffer this punitive additional rate. Now, anybody who gets it is some kind of egregious tax avoider. I don't get it, and it's got to be cut back, and it's not fair, and it's not appropriate. Well, in a year, I could understand it if it took them 3 years to come to this glorious conclusion, but 10 months? I mean, it just seems preposterous. But anyway, Alex will explain what it means and how it all works. And then, of course, following on from that, you get no change to income tax, no change to VAT, because we've got the tax lock, haven't we? We've got the tax lock. And I think to myself, yeah, we've got that tax lock, haven't we? Because it was all part of the 2015 manifesto that we won't put up income tax, VAT, and national insurance contributions. Oh, whoops, national insurance contributions. Damn, did we say that really? And I think, well, hold it, last year, wasn't that dividend tax? Wasn't that sort of income tax? Isn't that income tax? Oh, no, that's not income tax, that's dividend tax. Completely different, nothing like income tax at all. How could you be so stupid as to make that mistake? So, they introduce these locks, these promises, and they break them. And why should we be surprised? I'm not surprised. I mean, it's just what they do all the time. So anyway, CGT, nothing other than a slight increase in the annual exemption, which is good. So I will be talking later about some planning opportunities around something called entrepreneurs relief. No significant changes to inheritance tax either. Now, a load of sort of old nonsense, really. The first one is not nonsense. And again, Alex is going to tell you a lot about this. There is something coming down the line called MTD, Making Tax Digital, if I can say it. Making Tax Digital. Or as we like to say in the accounting profession, making tax difficult. And whilst the announcement in the budget was a welcome relief for small businesses, because previously they were saying that if your turnover is more than 10 grand, you're going to have to start doing this pretty damn soon. Now they're saying, unless your turnover is more than the VAT registration threshold, you won't have to do this pretty damn soon, but there will be plenty of small businesses whose turnover is above that threshold. So this is really important that this word is got out. It is going to become a nightmare, I can see. I mean, this whole drive, it was hailed by George Osborne as no more doing an annual tax return, which, cool, talk about disingenuous, eh? You think, oh, that's great, no more doing a tax return, this is brilliant. No more doing an annual tax return, no, instead you can do 4 tax returns. You think, oh, that's not quite as good as I was hoping it was going to be. But anyway, Alex is going to tell you all about that. Now, what else does the old cynic in me think? God, this is stupid. The NSI savings bond, massively trumpeted, much heralded. You can get 2.2%. This is fantastic news. Fantastic news. Minimum investment, only £100. Fantastic news. Fantastic news. Maximum investment, 3 grand. 3 grand? What? What's 2.2% of 3 grand? Shit, that's 66 quid. What? This is not going to make me millions. I'm not going to retire on this. Is there another plan, please? Right, next one, pensions. I say there's very little on pensions, but this was announced. CUROPS, qualifying relevant, I think it stands for. I thought it was registered, but I think it's relevant overseas pension scheme. Which is part of the legislation that was introduced by the 2004 Finance Act when the great A-Day reforms came in from April 2016. It was all part of the plan. Yeah, you can transfer your pension to an offshore scheme as long as it's the right kind of scheme, as long as we like it, as long as it's got the right rules, this, that and the other. Well, they've come to the conclusion that nobody's got the right rules and nobody ever will have because they're not British. So there's going to be a 25% tax charge unless you are going to an EEA territory, and unless you are also going to the EEA territory. So of minimal importance. Very quickly, the business rates relief package. I mean, that my ears pricked up that, where it seemed to be really good for pubs. This is excellent news. I'm all in favour of anything that's good for pubs. It always makes me laugh when people talk about EIS relief and EMI share options. There are these good trade, bad trades. What are in the bad trade rules? Well, there's all sorts of dreadful things like being an accountant or a banker, obviously. Obviously, that is beyond the pale. But other things which are shocking are being a farmer, for instance. Property development, obviously shocking. But running a nursing home, bloody hell, don't want that sort of thing going on. No nursing homes around here, mate. But pubs, yeah, perfectly all right. So nursing homes bad, pubs good. And here, in our business rate relief proposal, pubs sort of came out on top, which is all jolly good stuff. R&D tax credits, Alex is our expert. We are in the presence of greatness here, so Alex is going to tell you all you wanted to know about R&D tax credits. If he can make head or tail about what that announcement is about, he's a better man than I am, Gunga Din, but I have every confidence. More tightening of the compliance regime. They're going to do very unpleasant things to people who enable tax avoidance. I hope there's none of those sort of coves in this room. Now, very quickly, one last slide before I give you Alex. There are a load of stuff coming down the track which weren't in the budget, but it's worth bearing them in mind because they are coming online more or less immediately from either the 1st or the 6th of April. And what am I talking about? The new rules regarding non-DOMs. If you're a non-DOM, you've got new rules, and they are wildly onerous, wildly complicated, full of pitfalls, and need very careful management. So I will say no more about that. There are much publicised restrictions coming online for the deductibility of interest for buy-to-let landlords, people who own property and want to offset the interest charge against their rental income. Those rules are changing for the much the worse, with effect from the 6th of April 2017. If you're not aware of those and you're not aware of what you can do to get round them, you need to talk to us. But I'll touch on that when I do my summing up spot. Restriction of interest for large corporates. I mean, this has passed a lot of people by, but if you are a large corporate that pays interest of more than £2 million a year, you are going to have your interest relief restricted to either £2 million or 30% of something called your tax EBITDA. Again, I won't bore you with it, but this is upon us. If anybody thinks they're in that situation, they need to urgently take advice. Salary sacrifice arrangements. This was announced previously, but from this April, if you have salary sacrifice arrangements which are not in respect of pensions, not in respect of nursery schemes, not in respect of cycle to work arrangements, then there are new rules designed to get more tax out of you. You need to be aware of that. There is a relief called the substantial shareholding exemption. Very valuable relief for corporates who sell subsidiaries. That is being reformed for the better. That is good news. Why are they doing it? Well, they introduced it back in 2002 deliberately to as a reaction against Luxembourg and Netherlands structures which benefit from something called the participation exemption. When you sort of compared and contrasted whether the UK was a good holding company location compared to the Netherlands or Luxembourg, on certain grounds you could say, yes, it's great, but on other grounds you thought, oh, it's not so great, so they introduced this relief, and they've twigged that the relief is rather too narrow, and Luxembourg and the Netherlands are still stealing a march, so changes are coming through. And the final outrage, my final rant for the day, for the morning, before I go for my next one, is that the inheritance tax residence nil rate band, which was announced ages ago. The Tories said, if we get elected, we will put the inheritance tax threshold, as I like to call it, up to £1 million. And we all thought, do they mean £1 million? Or do they mean 2 lots of £500,000? I bet they mean the latter. And they certainly did. But then when push came to shove, they didn't really deliver. They said, oh, well, what we'll do is we'll leave it where it is at 325, where it's been since time immemorial, I hasten to say. And we'll introduce a new complicated version, which is all about properties, and it depends who you leave it to, and it depends on the value of your estate as well. So if you've got an estate of more than 2 million quid, you don't get it. So we'll introduce something where we can pretend we've introduced a relief in a manner that nobody qualifies. Brilliant thinking by the politicians. And what else will we do? We'll introduce it in the future. So we'll announce it now, we'll talk about it a lot, we'll make people feel warm and happy, but it doesn't come online. Well, it's come online, will come online from the 6th of April 17, so hurrah, but it's the first of many instalments, so the first 100,000 of relief, if you're entitled to it, you will start to get.